Hello and welcome everyone to today's webinar on My CPE. My name is Kate Jones and I'm joining you from Houston, Texas. I hope you're safe and healthy, and it's my pleasure to be your moderator for today's webinar. Firstly, I want to make sure your audio and video are working properly so you can see the screen and hear the sound. Please let us know in the chat panel. Also do let us know where are you joining from, that is the city, state, or any part of the world. All right, folks. We have folks from Denver, we have folks from Dallas. All right, we have folks from all over the country here. All right, thank you so much everyone for confirming. And thank you for joining us and supporting our One Credit, One Meal social initiative. For every credit that you receive on our platform, we donate one meal to an unserved under our One Credit, One Meal program. So thank you again for supporting our wonderful cause. One more important thing, everyone, to obtain the credit certificate, it is required as per the regulations to remain in the session till the end and answer all the polling questions, and an evaluation form shall be sent within 24 hours of completion of this webinar if you have answered all the polls. And as we all know, this is an interactive webinar, so please feel free to put your questions in the Q&A panel and the presenter would be happy to take them on the go or towards the end if the time permits. And lastly, if you get any technical issues, please feel free to reach us in the chat panel or email us at support@my-cp.com. And just for your reference, we'll be also giving you the instructions in the chat panel. So now then, everyone, let's move on to another part of this session. Yes, the presenter for today's webinar, we have Mr. Henry Montag with us. He's an independent experienced CFP and ABA author concentrating in unique strategies for retirement and financial planning for almost 4 decades now. He's a co-author of the Advisor and Trustees Guide to Managing Risk, author of over 100 professional articles and 100 professional presentations. So without any further, Henry, the floor is all yours now. Thank you so much.
Thank you very much. First of all, I'd like to thank you, Kate, and I'd like to thank my CPE for hosting the session today. And of course, I'd like to thank our attendees for being with us. I'm looking forward to spending the next 50, 60 minutes just basically going over some information that I've picked up, as Kate said, over the last 35 some odd years. And I'm sure that some of the information will be useful both to yourselves as well as to your clients. So let's start with going over the objectives. And some of the things we're going to be talking about are, what are your clients' objectives? Matching the objective with the correct type of policy and design, I think, is probably paramount in terms of some of the discussions that we'll have today. We'll be talking about the death benefit as well as the living benefit. We'll also be talking about the settlement options. Settlement options are the way that the insurance company gives you the opportunity to collect the money in the event of a death benefit. We'll be covering the 6 most popular types of life insurance policies and the best use for each one. We'll be talking about some of the problems that the consumers have had, specifically with non-guaranteed universal life. We'll also be talking about the advisor's role in preventing a problem, fixing it, identifying the problem, and also be able to talk about the underwriting process. In other words, what's the process behind the scenes once an individual completes an application? What does the company do? What do the underwriters do? And what's the underwriting process? Also interested, of course, in becoming and having every one of us become more familiar with your own as well as with your client's portfolio. We'll be talking about maximizing your coverage for the current premium that you're already paying. We'll be talking about guaranteeing the survivor benefit for estate tax purposes using something called second to die or survivor joint life policies. We'll be talking about the tax treatment and a quick word about future courses. So to start with, there are basically 2 functions of an insurance policy. Everyone's familiar with the death benefit. Not so many people are familiar with life insurance as an asset class when it also acts as a living benefit. On the left-hand side, you'll see where it says term, universal, guaranteed, non-guaranteed. Underneath accumulation for maximum living benefits, you'll see the whole life, the indexed universal, and the variable universal. Those are the 6 policy types that we'll be speaking about. And as you can see, some of them are guaranteed, others are not guaranteed. Some are good for living benefits, some are better for death benefits. There's no such thing as a bad policy. It's only a policy that's misused or mismanaged that makes any difference. So let's first talk about the traditional death benefits. Death benefit basically provides a family income, pays off debts, pays future state tax liabilities, can also be used to pay the new tax from the Secure Act. It can provide an educational fund for families, children. In a business setting, it could also be used for buy-sell agreements for business partners. And of course, it could also be used to provide legacy gifts to the next generation. Under the living benefits, I'm not going to say much right now because we'll be covering that on my next course. But let me just hold off on that until the end. But the living benefits are not going to be discussed today. We'll only be discussing with the traditional death benefits. The settlement options, not to be confused with a life settlement, is the way that the insurance company pays a beneficiary in the event of a death settlement, the event of a death claim, rather. The most popular choice, of course, is cash, but there are various other options that you should be familiar with. And since they're annuities offered by the insurance companies, they offer a guaranteed payout for the rest of the beneficiary's life. And then that could be done with a life only. It could be done with life and another survivor. It could be done with an individual's life only for the beneficiary, and then a certain period of time, whether that be 10 years, 20 years. Basically, my advice here is for an individual to not just accept any of the settlement options from the insurance company, but to recognize that there are hundreds of insurance companies and they all provide settlement options. And everyone should always get into the habit of shopping around for the best offer. Okay, so when do people use this stuff, or how often do people buy life insurance? Well, I just made a quick listing. It's basically when they buy a house, when they have a child, when they have a second child, when they buy a larger house or a condo, if they start a business or apply for a business loan, if they have a business partner, there's going to be used for buy-sell. Individuals eventually will want to pay for or prepay for their federal estate or state inheritance taxes if they fall into that category. And they certainly could use a death benefit of a life insurance policy to leave a legacy gift for the next generation. They can also use a life insurance when they want to set up a supplemental retirement plan, or when they want to use life insurance to pay for long-term care costs. The reason those two are in yellow is because I've highlighted those because those are part of the living benefit of a life insurance policy. But of course, they also act as a death benefit as well. So there are 6 types of policies. The first one and most popular is term insurance. Term insurance can provide the lowest cost and it can provide a maximized death benefit. People have to ask, what's the purpose of the coverage? How long does the client want to keep the coverage? How many years are left? And the guaranteed duration of any term policy can either be 1 year, 5 year, 10, 15, 20, 35, 30, 25 rather, 30, or even up to 40 years. But the drawback is that term insurance ends anywhere between age 80 and 82. In other words, a 61-year-old can purchase for maximum a 20-year term policy, which will take him from 61, 20 years to 81. If an individual is 62, they can get away with a 20-year policy going to age 82. However, that 63-year-old individual will no longer be able to purchase a 20-year policy because that would then take him or her to age 83, and that's a no-no. So what's guaranteed? The death benefit is guaranteed in a term policy, the premium is guaranteed, and the duration, be it 1 year, 5 year, 10, 20, 30, or 40 years. Now, an important point, excuse me, an important point. There are individual policies which individual can purchase and keep for the rest of the term life, regardless of where he or she works. However, there are sometimes discounts offered with group association or group term policies set up with an association or with a company. They're a little bit less expensive. However, there's some problems with them. And some of the significant problems is that, let's just say if you're a CPA and you're part of the AICPA, you would have to maintain your membership with the AICPA. Otherwise, that group association term policy that you have will not remain in force. If you have a group policy with an employer and you leave that employer, the problem is that you will not be able to, in most cases, to take that coverage with you. Or if you can, the coverage that you could take with you is below par in terms of what other available coverages might be out there. It's a fail-safe, but it's not a good fail-safe because association products, they're very, very good in the first 5 or 10 years. But once an individual hits age 45 or 50, the costs significantly increase every 5 years, and the death benefit at certain ages begins decreasing, and at 75 it will end, and it's not a very good product. If people, and I'm sure that there are people out there that currently have that group association term, if you want to find out a little bit more about it, just shoot me an email and just ask for the article regarding group association term. Conversion options are very, very important. Some conversion options take place at 60, or I shouldn't say they take place, they end at either 65, or with some companies, they'll end at 70, or some companies, they'll even go as far as 75. What that means is that if you have a 20-year policy and you're going into age 75, 74, and your conversion option ends at age 75, if you're in good health, no problem. You could probably go out and shop that coverage with any other company. However, if you're not in such good health, the conversion option in a term policy guarantees you the right to be able to increase, to be able to convert rather, that term policy from a policy that would otherwise end at age 80 or 82. You could convert that to a permanent policy. And the only reason that you would do that is if your health deteriorated to the point where you now realize that you want that coverage beyond age 80, and you might have some medical issues, and you might not be able to qualify for insurance in the general marketplace. At that point, having the conversion option in your existing term is priceless. And again, compare, whatever you have, compare what you have, compare what you're paying, and see what else might be available today. There's no cash value in a term policy. And as I said, most term policies expire at age 80 to 82. And an interesting point, interesting fact rather, only 2% of the death benefit in a term policy ever gets paid out. So since it only goes to age 80 or 82, and with today's modern pharmacology and modern medicine, people living quite a bit longer than age 80 or 82, there's some correct uses for term, and there are also some incorrect uses for term. The incorrect uses for term is, say, if somebody has a child with a problem and they want to provide specific monies for that child, they might use a supplemental needs trust or a special needs trust. You want to make sure that that policy remains in force for the balance of the second parent's life. And that might not be sufficient at age 80, 82. If someone is interested in leaving a legacy, again, with people living mid-80s, that's not the right policy for a special needs trust or for leaving a legacy for a child. So we now come to the first pop-up question. Kate, is there anything that you need to do on this?
All right, so the polling question is up on the screens now. Please make sure to hit the submit button to register your responses here. The question says, which is not a good use for term INS? We'll keep the poll open for 30 seconds. And Henry, the floor is all yours now. Thank you.
Okay. How do I get rid of my polling question? Let me try this. Okay, so whole life. There are two policies that I described as chocolate and vanilla in the days of old when Carvel ice cream had its heyday. Vanilla was term, chocolate was whole life. 100% of the policy is guaranteed for the balance of the insured's life. This policy forces you to accumulate maximum cash value, whether you want it or not. It provides the least amount of death benefit for the premium paid. And the premiums, the higher premiums are, of course, are there to be able to support the higher or highest level of cash value. The rates of the return are guaranteed at 3%. Usually a whole life policy might pay a dividend. The dividends are not guaranteed. Basically, the client assumes a 0% market risk. That is, unless they use the dividends to buy term insurance or to reduce premiums. A whole life policy, if all the premiums are paid, is 100% guaranteed, and most policies today are earning 3%. And let's just spend a second just talking about what is cash value. Basically, cash value is the amount of money that is left after you pay the premium. Year one, you might pay a $10,000 premium. I'm just making up these numbers. You might pay a $10,000 premium, and the expenses are $500. The cash value in the first year, what's left is $9,500. At the end of that first year, that $9,500 is going to grow, assuming 3%. My math is not accurate here, but I just wanted to make the point that that cash value from $9,500 will grow, and that will occur each and every year. The new premium is paid, the expenses are deducted, whatever the cash value from the previous year is grows, and that's your cash value. And at the end of your 60th, 70th birthday, that cash value will accumulate and grow and be quite significant. Whole life policies are excellent vehicles for a conservative return of accumulation, as well as providing a death benefit. And that accumulation, of course, as we'll see in a few moments, is all done on a tax-favored basis, but it doesn't provide the maximum death benefit. An indexed universal policy can be a very good choice because it provides a guaranteed death benefit. The return is based on the growth of or the loss of the specific stock index option that's chosen. So in other words, instead of having a 3% guaranteed as you do with whole life, the cash value in an index policy will grow or lose money based on the stock index that you've chosen. The premium can be set at a desired level to provide a guarantee till age 90, 95, 100, 110, 120. It can be set to pay the lowest available premium while still providing a death benefit. And the mechanics of how this works, with an indexed universal life, you agree not to take 100% of the gains. Let's just assume that your gains are $10,000 at the end of the year. With an indexed universal, you agree to only take 75% of those gains. But the upshot of that is that in the event that there's a loss, there's a floor on your losses. If the market goes down $10,000 and you had $100,000 of cash value, you don't lose that $10,000 because you've agreed to give up 25% of the gains. You therefore are rewarded by being protected in the event of losses. You won't lose money in the event that your cash value or the stocks that are driving that cash value declines. It's an excellent vehicle for both maximum death benefits as well as accumulation and distribution planning. Next, we're going to talk about something called a variable life insurance, variable universal life. And I've separated them out into two separate areas. Traditional variable universal, death benefit is not guaranteed, because if that market goes down year 2 or 3 and then goes up a little bit in year 4 and then goes down again in year 5, all of a sudden your death benefit is not looking so good. Basically, people have to make up the additional premiums in the event that cash value is not doing what it should do. In other words, the client assumes 100% of the market risks. It's a good vehicle for overfunding, meaning paying more than the stated premium. And that allows that additional monies to grow, accumulate, and it's a wonderful vehicle for distribution planning. Only downside is that it just doesn't provide any sort of guarantee and you have 100. The client has 100% of the market risk. The private placement, I'm going to just basically say that private placement is like a variable universal policy on steroids. It just does more, and I'm going to leave that because that's one of the living benefits, and I'm going to save that for when we talk about living benefits. Now we have the non-guaranteed universal policies, which make up about 55 to 60% of the market. The duration of coverage is based on the changing annual interest rates. When rates are high, people earn more. When rates are lower, people earn less. Problem with this is that people who purchased these non-guaranteed universal policies 15, 20, 25 years ago, when rates were significantly higher, weren't made aware that in the event that rates go down as they have, that they would have to increase the premium to make up for the fact that the interest rates were not on par with what they had been expected. Most people were not aware that they had to do that they should have paid a higher premium, that these policies needed to be managed. And as a result of that, much of that coverage is now ending years earlier. It's the least expensive form of permanent insurance because this type of insurance can go on till age 90, 95, 100, 120, but it's just not guaranteed. Let me give you some examples. Why is this problem? Why is this non-guaranteed universal such a problem? As I say, 60%, roughly 60% of these types of policies are not guaranteed. The interest rates decreased over the last 20 plus years, but the billed premium from the insurance company and the death benefit remained the same. So the premium remained the same, the death benefit remained the same. The only variable rather, was the duration. And that resulted in a shortened duration of coverage. The owner trustee should have increased the premiums, but he unfortunately didn't know that they should have. And that's the difference between somebody buying a policy and holding it as opposed to buying a policy and managing it. And as a result of years of reduced interest rates and neglect, 40% of coverage today is increasingly expiring prematurely. Here's the example. Individual 30 years ago bought a $1 million policy, wanted it to not be guaranteed because there was no such thing 30 years ago as a guaranteed universal. That didn't come about until approximately 2003. But back in the 90s, individual purchased a policy for $1 million. Premium was $14,000. Back then, $1 million state tax floor. So naturally, the next step would be, let's put the policy into a trust and let's pick a trustee. Well, there's no mention of the fact that there was a guarantee or that there was a duration of coverage or that people needed to manage that policy or that the trustee needed some sort of specialized knowledge or skills, nor that he had some pretty significant fiduciary liabilities and ongoing responsibilities. Well, that 8 to 9% interest rate that they assumed was not achieved. Actually, over the last 30 years, it comes out to about a 4.1 actual interest rate that was achieved. At the current $14,000 premium, that policy is set to expire at the end of this year at the insured's age 86, not 95, as had originally been thought. The premium needed today to cover that policy, to provide coverage till age 95, is basically double, $26,000 instead of $14,000. At the $14,000 premium, that individual's current premium would provide only $450,000 of coverage to be maintained to age 95. This is the result of a buy and hold as opposed to a buy and manage. Non-guaranteed universal policies are good products, but they don't come with automatic self-management. That's up to the trustee. Wall Street Journal happened to have endorsed the American Bar Association book that was written, The Advisor's Guide to Managing Risk. And I'd been in touch with Wall Street Journal for many years, advising them of the problem. Leslie Chisholm, senior editor, had this to say. I've written multiple stories over the last 5 years about the impact of low interest rates, blah, blah, blah. Point is that she basically has told the consumers that many policies are expiring because people weren't made aware. Sometimes the agent or the broker is no longer in the picture. People just put the policy in the left-hand drawer, assuming that it'll be there. And unfortunately, they're surprised time after time after time. Gentleman Donald Walters, general counsel to the insurance marketing agency, has basically said that, yeah, we've got a problem. We haven't talked about it much, but the industry does have a problem with lapsing universal life policies. So what's the solution? Item 6, the guaranteed problem, the guaranteed policies, guaranteed universal. The quoted premium with a guaranteed universal guarantees a specific dollar amount, guarantees the specific premium, and it guarantees the specific time period that the policy will remain in force. Minimizes the premium for guaranteed death benefit. Insured assumes zero risk as long as the premiums are paid on time. And this type of policy is, and as far as I'm concerned, one of the policies that I go to most often for a client that's looking to provide not accumulation planning, but to provide a death benefit on a guaranteed basis for the lowest available premium. So this brings us to pop-up question number 2. Kate?
All right. So the second polling question is up on the screens now. Please choose a response and hit the submit button to register your responses, everyone. The question says, what's major problem with non-guaranteed INS? You have got 3 options here. We'll keep the poll open for the next 10 seconds and we'll end the poll. Okay, it's 5, 4, 3, 2, 1. Thank you so much, everyone, for submitting your responses. And Henry, it's back to you now. Thank you.
Okay, thank you. So some of my observations are that the insurance company certainly could have done a better job of communicating to the client or to the agent or broker that initially marketed that policy to the insured. Agents should have been directed to service their clients better. The insurance company certainly has the ability of doing that. New compensation agreements should be arranged currently. An agent or broker receives basically 100% of the commissions in year 1. There are some small 2% or 5% servicing with various whole life policies. But again, with the guaranteed universal or the non-guaranteed universal or the indexed universal, 100% of those commissions are paid up front, and the agent or the broker basically has no skin in the game. And other than ethical real considerations, he or she is not forced to provide any type of service to that insured. And as that aside, the insurers benefit when policies expire. So they might not have that much of an interest in preventing policies from expiring because, trust me, the insurance companies like when a insured pays a premium for 10, 15, 20 years and then realizes when they receive a letter from the insurance company telling them that the policy that they have, because the interest rates have decreased and the policies are now set to expire in the next year, and the insured now has a premium that he's got to make up in 1 year that he or she should have been making up over the last 10 or 15 years. Some insureds say, I don't have the money to pay the additional premiums. Or some insureds take the bravado attitude of, insurance company, I'm not paying the premium, cancel my policy, take that. Either way, the insurance company wins and the insured loses. Most people basically do a terrible job of managing their life insurance for various reasons. One, they just don't understand it. They emotionally don't want to deal with it. And 3, oftentimes, they just don't trust the individual providing them the information. So what's the attorney's role or the CPA's role in managing the client's TOLI or trust-owned life insurance or individually owned life insurance? My company happens to be the TOLI Center, but the process is the same whether the policy is owned by a trust or whether the policy is owned individually. So the attorney certainly discusses the creation of the trust, the ownership of the trust to make sure that it's out of the insured estate. Currently, that might not be so much of a problem with $11 million of an estate tax exemption, but that always hasn't been the case, and that will not always be the case in the future. More about that later. The CPA, the accountant, certainly provides the crummy provisions and the trust gift tax returns, but they're both usually not involved in paying sufficient attention to the client's life insurance portfolio. They'll pay attention to the crummy provisions letters, they'll pay attention to the trust, but unfortunately, oftentimes that life insurance policy is really an orphan. The annual monitoring and performance evaluations of the life insurance policy is not something that most accountants or attorneys do for various reasons. The providing guidance to the amateur trustee, who basically is the son of the daughter of the insured, who basically has less information, less knowledge about the life insurance policy that he or she is responsible for, even less than the insured, than the father or mother who are being insured. They don't do a very good job of helping determine what the future premium payments are going to be. As I said, insurance companies are still billing the insureds for their non-guaranteed policy the same premium rates the same premiums that they billed 15, 20, 30 years ago, when rates, as I say, were much lower. They're not determining that the current rates, or in order to keep that policy in force beyond life expectancy, needs to be increased. They're not advising the clients of that. And the clients, trust me, have no idea that their policies needed to be managed or that premiums needed to be increased. The insurance industry did a terrible job. I can say that, from having been in the room when it happened. They simply,
guys.
I'm sorry. Kate, your mic is on. Okay. You're basically going to be one of the only ones to bring it to their attention. And if you don't, nobody else will. Okay, so the blame game. Whose fault is it that my coverage is ending prematurely, or that I've got this huge bill that I've now got to pay? Well, the insurance company should have contacted me. No, the insurance company only has to send you the policy and send you the bill and pay the death benefit. Well, my agent broker should have alerted me. Case law says that's not the case. It's not your agent, not your broker's responsibility. Well, my attorney that drafted the trust, nope, case law on that one too. Unless the attorney is also the fiduciary as a trustee, he or she has no responsibilities. Well, my CPA that prepares some sort of crummy letters or something, I sign them every year. Nope, CPA is not responsible either. It's none of their legal responsibilities. But no one told me that my policy needed to be managed. Just had a case the other day where an attorney called me up and had a client complain. What can I do? Nobody told me. From previous experience, I just had to tell that attorney, there's nothing that can be done. And even the state insurance department on a complaint basis is not going to do anything. Why? Because it's the private trustee's responsibility. That private trustee, that amateur trustee, that unskilled trustee, the son of the daughter of the insured, he signs his life insurance policy with the owner, but he receives no future guidance. He files the policy away in the bottom left-hand drawers. If he's lucky, he or she reads the annual statements, but they're unaware of the assumed liability that they've taken on. They're unaware of the assumed monitoring responsibilities that they've taken on. They're unaware that they have 100% of the performance risk that they personally have assumed as a trustee, fiduciary liability. I can't tell you how many times I've seen problems occur with brother suing sister, or sister suing brother, because what do you mean our dad's $1 million life insurance policy is no longer available, is no longer in force? What do you mean? They're not aware that they need to increase premiums. They're often out of touch with the grantor's attorney. And here's the worst part for the attorneys that might be listening in. Oftentimes they assume that it's the grantor's advisor, the grantor's attorney that's taking care of these things. It's not the case. There's no liability, responsibility to do that. And believe me, the accountants and the attorneys are busy enough, and they have no legal liability to take care or advise the grantor, because to advise rather the trustee, because it's the grantor's attorney, not the trustee's attorney. 90% of trustees are unskilled, with only 10% being managed by a professional trustee, an institutional trustee. Why? Well, institutional trustees charge about 1% or 2%. So on $1 million policy, people say, wait a minute, why am I going to be paying a institutional trustee? I can have my son and my daughter, my friend, my cousin, my wife. Well, the difference is that the institutional trustee does things right, and the son or daughter or the amateur unskilled trustee unfortunately doesn't. As a result of that, 35 to 40% of existing policies are expiring prematurely. How can a client fix some of these things? The client must obtain and evaluate the annual summary statement or the historic projections to determine if adjustments in premium are required. And I can tell you from years' experience that if you have looked at that policy over the last 10 or 15 years, yes, there's certainly adjustments that need to be made, because we can think back 15, 20 years when interest rates were significantly higher than they have been over the last 10 or 15 years. Or they should just engage an independent, experienced broker or consultant to evaluate the individual's policy and to obtain that annual summary statement and obtain the historic projection. Insurance companies send an annual summary statement, 4 or 5 pages. Somewhere at the bottom of page 3 or 4, there's a little print there that says, warning, your premiums are not guaranteed, and interest rates can subject the coverage to expire prematurely. And it's there, but you've just got to look for it on the bottom of page 3 or 4 in very small print, I might add. Again, insurance companies like when policies expire prematurely. Client options are to be able to reduce the face amount of the policy. Certainly. They can pay a higher premium. Certainly. They can obtain a new guaranteed contract if they're still healthy and if the transaction makes economic sense. They can sell the policy, or they can try to make various provisions to incorporate a combination of several of the 4 items that I mentioned above. First option should always be to try to manipulate that contract to keep that contract, just pay a higher premium or reduce the death benefit, because sometimes people aren't always insurable when they begin realizing that there's a problem. How do you reacquaint with your own portfolio? A couple of questions to ask yourself. Is the death benefit or your coverage currently sufficient? What type of coverage do you have? How long do you want your coverage to last? Is it an individual or group term policy? Very important. If you're sitting with an individual with a group term policy, take a look at it. Read what happens to the premiums. Read what happens to the death benefit. Read what happens to the dividends. It's all bad news once you hit age 45. Till what age can a policy be converted with no medical exam? Many people have term insurance. They're sitting there. They're 60, 65, 70 years old. They may not be in the best of health. They're sitting there with an option to be able to convert a policy, but they've got to be able to become aware that that option doesn't last forever. And whether it's 65, 70, or 75, it's going to expire. The sooner a person gets a hold of this information, the sooner, the more opportunities, the more options they'll have available. And I guarantee the less costly those options will be. Are you getting maximum value for your premium? Shop around. There are hundreds of insurance policies, 100 of insurance companies rather, and they all have different pricing. There's no such thing as one price fits all. You've got to shop around. When was the last time you personally, to my audience, reviewed your own insurance portfolio? Are all the beneficiary designations reviewed? Are they updated? I have to tell you that people who get divorced, maintain their wife or their husband as beneficiaries. And no, it doesn't matter that you've been divorced for 5 years. If the beneficiary designation of that policy says your husband or ex-wife, guess who the money's going to? Okay. What are some of the individual things that people can do? And the most important is what I've highlighted in yellow at the bottom. Compare what you think you have to what you have and to what you want. Avoid family disputes. Prevent premature lapse. Compare costs. It's possible that you might be able to do better. Insurance companies have had not rate decreases, but with modern pharmacology, people are living longer. As a result, people who've purchased policies, people who have purchased policies more recently probably have a better mortality rate because people are living longer. No more to be said on that. Could we just do the next pop-up question, Katie?
Yeah, thank you so much, Henry. So the polling question is up on the screens now. It says, what are the benefits of a live INS evaluation? Please make sure to hit the submit button to register your responses here. We'll keep it open for the next 30 seconds. Okay, what about the questions, Henry? Do you want me to read it for them right now? So we have got one question here.
Sure, I'll take the question now.
Okay, so the question says, upon maturity, how is the proceeds taxed?
Well, actually, I think that's on my next one or two slides. So let me hold off on that because I'm going to talk about that in just one moment. Okay, the next slide is actually talking about the taxation. So let's talk about marketing and let's talk about underwriting. Underwriting is applying for a policy. As a result of the pandemic, things have changed and things are changing back again. I just got a couple of notices from some insurance companies that they're going back to pre-pandemic rates. This just is happening as we speak. So insurance companies obviously took a more conservative role. They stepped back. They reduced the people I used to be able to market an insurance policy to an individual age 82. Many insurance companies cut that back to age 75. And now insurance companies, again, are going back. What's the difference between an agent and a broker? An agent is somebody who works for one particular company and has an obligation to place their business with that company because their offices are paid for, their secretaries are paid for, their health insurance is paid for, their retirement benefits are paid for. Somebody winds up paying for that, and that's the individual consumer, as opposed to a broker who's independent, who has the ability to go into any company. I myself as a broker, unfortunately, nobody pays for my office, nobody pays for my secretary, nobody pays for my health insurance, nobody pays for my retirement. But if I wanted to give up my independence and become an agent at a company, I get all that taken care of. As a consumer, writing's on the wall. New best interest regulations are set to protect the consumer. That's a good thing. Individuals in my business now have to put things in writing and now have to disclose. The difference between a mutual company and a stock company, make no mistakes. A mutual company is there for the policyholders. A stock company is there for its shareholders. Majority of companies that offer insurance are stock companies, and they have no interest, or no obligation, I should say, as well as probably no interest in doing what's in the client's best interest, because they have no obligation to do what's in the client's best interest. They have an obligation to do what's in their shareholders' best interest. Applying for coverage. As a result of the pandemic, easy applications, or the application process has become easier. Oftentimes it can be done without a medical. Oftentimes it's just done with a telephone screening interview. Qualifying for coverage be honest with the individual that's taking your application. Be honest with the insurance company. They have ways of finding things out that you're just not aware of. And again, when I talk about underwriting, I'm not just talking about your medical underwriting. Yeah, they do have the ability of going out and finding any doctors that you've seen. They do have, there's something called the Medical Information Bureau. They share information on that. They do have the ability of going into your history. And by the way, when you sign the application, you give the insurance company the right to do all these things. So it's not that they're doing anything behind your back. It's just that most people don't read the applications that they're signing. But you do have the obligation to be honest with the insurance company for several reasons. One, they can wind up basically just nulling and voiding your contract in the event that there are any problems or lies for the first 2 years, called the contestability period. Even beyond the 2-year period, if somebody makes a material misrepresentation, there's no such thing as a 2-year period. And underwriting does not just deal with medical, it also deals with financial. If you're applying for a $5 million policy and you're renting an apartment and you have a $40,000, $50,000 job, the insurance company is, I'm exaggerating, the insurance company is not going to give you the $5 or the $10 million policy. The financials have to fit. For most people in their 30s, 40s with kids in a house, it's anywhere from 15 to 20 times. The maximum coverage they can get is anywhere from 15 to 20 times their salary. And from a social underwriting point of view, if you've had that DWI, if you've had that DUI, admit it to the insurance company, because they will write to the Department of Motor Vehicles and they will find out and they will punish you if you don't disclose the information and if they have to discover that information on their own. Be honest. Be honest. Okay, getting back to the tax treatment of life insurance. The question said something about when a policy matures. There are two ways that a policy can mature. One, when an individual turns 100. I don't think that's what the question was about. I think what the question was about, and please clarify if I'm wrong, is when a death benefit is paid. So life insurance, if set up properly, no income taxes are paid on the death benefit. If it's set up properly, no income taxes are even, let me hold off on the distributions, but no income taxes are paid if the policy is set up correctly. No estate taxes are paid on the death benefit if the policy is set up correctly in a irrevocable trust. Irrevocable meaning that you have no access to it, you don't control it, you don't have the ability of removing the cash value from it. If it's owned, set up properly by irrevocable trust, there are no taxes. And why is this important? Because we have estate taxes, and currently we're dealing with an approximately $11 million exemption, which will be reduced to $6 million when the sunset provisions will take place January of 2026. And sometimes people over the next couple of years say, well, I don't have an $11 million estate. Be aware that the state inheritance taxes have a lower threshold. And, somewhere in the vicinity of $6 million in New York State, you will begin paying estate inheritance taxes. And again, just point to keep in mind is that costs to pay estate taxes will increase for many individuals at the end of 2025. A better way to pay for future estate taxes, in my opinion, is a guaranteed universal life policy that maximizes and guarantees the death benefit, and match that up with a second to die policy, which offers the lesser expensive way to pay for these estate taxes, because a second to die policy pays at the death of the second individual, or the second insured, I should say, not at the death of the first. So let's just take a look and see what that looks like. Since funds won't be required till the death of the second individual, the guaranteed premium death benefit, let me take that back. Since funds won't be required until the second death, a survivor joint life or a second to die provides a guaranteed premium, death benefit, and duration with a lesser expensive cost than a traditional life insurance policy. As example, $500,000 guaranteed to age 96. For male age 78, individual cost would be $31,000. For the female age 74, the cost would be $18,000. But the cost to insure them both and have the death benefit be paid at the death of the second individual, that cost is $16,700. Might make more sense for a couple to consider a second to die, because it's ideal to be paid for estate taxes, because that's exactly when the death benefit or the liquidity is needed at the death of the second individual. It's also a great ability to prepay the future tax liability with leveraged dollars for both estate taxes as well as for the Secure Act, which again, I just mentioned that because there are now additional taxes to be paid as a courtesy of the Secure Act at the end of a 10-year period for the inherited IRA beneficiary. And it's ideal for providing a legacy for future generations. Sometimes people want to leave X number of dollars for their children. And oftentimes with a script of a pen, an individual is able to sign his name and provide a death benefit for his children or grandchildren that they otherwise may not have been able to accumulate over the course of their lifetimes. So we're getting close to the end. I'm just going to say that some of the next 3 upcoming programs that I have, the next one is going to be on the living benefits of life insurance. Next one will be on the long-term care funding options of a traditional contract. And the last one will be on future tax liabilities as a result of the Secure Act. And just a real quick point on that. Just yesterday, the House passed, not unanimous, but by 415 to 15, Secure Act 2.0. And you'll be hearing about that, I'm sure, over the course of the next couple of days, weeks, months. Most significant thing, as far as I'm concerned, is that the RMDs are now going to be pushed from what was 70 and a half to became 72 on Secure Act, and is now going to become 75 down the road. But the point is that there are going to be future changes in that Secure Act. I just went over some additional points on the understanding the long-term care options, as well as the Secure Act, as well as on the other options for the living benefits. So I think I'm running pretty much on time. I've left about 4 or 5 minutes for any questions. If there are any questions, I'm happy to take them now. If not, I'm going to be surprised. But Katie, are there any questions in the queue? Otherwise, I'm going to just take the next couple.
Just a minute, Henry. Let me check if you don't have any questions here. Okay, I can see one question here. It says, do I look for a product first or look for more trustworthy insurance company first?
Both at the same time, because there are different insurance companies. Different insurance companies, as I mentioned, are better for one type of a client's objectives than they are for others. It depends on the individual's health. It depends on whether the individual is looking for death benefit or accumulation benefits. So, again, it's not just one or the other. It's looking at them both.
All right. So let me check if we do have any questions here. Okay, we don't see any questions here. So thank you so much, Henry, for giving such an informative, insightful, and one of the most interactive webinar, I say. Go ahead, everyone. Let us know your feedbacks for this webinar.
I just have one more point to make. I've attached some handouts, which are very, very good. If I say so myself, there are a couple of Bloomberg articles that talk about the things that I just spoke about today. I've written a lot of articles. If anybody is looking for any additional information, I am a good resource. And, as part of my CPE courtesy, if anyone wants a opportunity to take a look and see what a performance evaluation by a professional looks like, if you just send me the client's first name and last initial, I will send back to you an engagement letter with complimentary written all over it. And you can give that to a client or you can use it for yourself. Point is, I'm here, I'm a resource. Pick up the phone, call me, email me, I'll get back to you. And again, thank you for spending the last 58 minutes. So with that, I will say goodbye. And Kate, I'm going to give it back to you for any any last minute housekeeping details.
Thank you so much. All right, so we do have one more question here. Where do I get the contact info?
Oh, if you download, okay. If you this was the copy of the book for the American Bar Association book that most of the information is taken from. It's a good book if I say so myself. There's my contact information, and you will also find my contact information on the handout material because I included a cover letter along with the articles.
All right. So thank you so much. And the knowledge and experience that Henry possesses is really priceless to us. And please feel free to use them as a resource for help. And lastly, let me check if we do have any more questions here. Okay, thank you so much, everyone. So lastly, for all the users, an evaluation form shall be sent within 24 hours to only those attendees who have answered all the polling questions, and it is required for you to complete the evaluation form in order to receive the credit certificate. We would request you to rate the webinar and provide us the feedback about the platform, speaker, content, and the webinar in the chat panel, as well as in the evaluation form. Also, you can follow us on social media so you can stay updated about the latest webinars and industry information. And lastly, if you need to view the recording of the webinar, if you have any further questions, please reach out to us at support@my-cp.com, and we would provide you the link to view the recording and will assist you further. So thank you so much for being such a wonderful audience. Keep coming back. Stay healthy, stay safe. Thank you so much, Henry.
Thank you, Katie, and thank you for listening. Thank you.
Thank you so much. Take care.